Yep. Good morning.
Good morning.
Oh dear. Oh no. Ken's having horrible technical problems. Good morning, everybody. I feel lost in a drift without our fearless leader, but he'll be back shortly. The extremely Christmassy Ken Adamo.
Good morning, Ned.
How in general, Dean? How's Boston? How's the greater Massachusetts area?
Pretty good. We're in the grips of winter. We typically hope for a white Christmas. I don't think we'll be disappointed. We've got about 6 inches coming Thursday, not as much as further south around New York City and further down towards Washington. So bit of a nor'easter. Nothing like a white Christmas in New England, though, coming from a country where you never see snow. This is it's always been a treat to see a white Christmas every year.
That's really lovely.
Yeah.
I'm not, you'd imagine you get sick of snow, but I guess not. I'm getting the signal that I'm temporarily in charge until Ken gets back, so I will abuse my power aggressively. Oh no, he's back. He's back. Dang. All right. I apologize again for the technical difficulties.
I don't know what happened. Must be the new
the
new studio growing pains. Did I miss anything?
Nope.
I called you a Christmassy Ken Adamo in honor of your amazing sweater.
I know this may come as news to some people, but I have a torso, as evidenced by the new studio set.
Yeah.
So again, sorry about the technical malfunction, guys. Figured we'd end the year on our official programming with a bang. So as always, we're here every Tuesday at 10 o'clock Eastern, 7 o'clock a.m. Pacific, with our weekly market update. This is our update for December 15th. I'm Ken Adamo, Chief of Analytics at DAT, joined by Ned Damon and Dean Croak. And I don't have to keep going over titles, do I, guys?
No.
No.
I think people have been watching long enough.
I think they know who I am.
So as I mentioned, this is our last official show for the year. Please, if you want us to kind of show up for one more intermediate show after Christmas, I've sort of strong-armed Ned and Dean into cobbling one together the week of the 29th. So let us know if you're interested in the comments or chat below, and we'll be more than happy to maybe do like an all-question show or something like that. What do you think, guys?
Yep, I'm good.
I'm game.
Yep.
All right, and only other thing to take care of, we will be, Dean, myself, and Chris Kaplis will be recording an episode of Freight Vine, kind of an end-of-the-year synopsis and looking ahead that will air this Thursday. So we're really looking forward to that, and we really advise you to check that out. There should be some really good content covering shippers, carriers, and brokers. So with that, I'm going to get into our key points for the week. So... kind of an interesting week. So spot load post volumes dropped as capacity loosened a bit. We saw flatbed and dry van rates spot down, but reefer cooling off the most. There's actually some really interesting things happening in the reefer space that Dean's going to touch on. And then as we roll into our long-term forecast, you'll actually see quite the sharp correction over the longer course of time. The Michigan State Truckload Index with our friend Jason Miller, up October year over year, mainly due to e-commerce. And then, the story dominating supply chain and even mainstream news is COVID vaccine distribution rollout. We had our first doses of vaccines administered. Tons of things to talk about as it relates to the big parcel carriers and LTL carriers getting this stuff moving. So with that, I'll turn it over to Dean to roll us into the weekly market update.
Yeah, thanks, Ken. Interesting week. There's typically a lot of noise in data around short work weeks, but last week was kind of interesting. We see a little bit of seasonality in the load board activity. The dry van load to truck ratio dropped back to pre-Thanksgiving week levels. That's significant because pre-Thanksgiving week was a 3-day week. Last week was a 5-day week. So doing the week-over-week comparisons, it's interesting that volumes dropped off so much. Dry van volumes were down 27% last week compared to the prior week. As a result, the load to truck ratio shifted down to 3.83, and about 15% more trucks were posting for loads last week. So Capacity did increase slightly. In the refrigerated sector, the load to truck ratio dropped back also to 5.56. Similarly to dry van, load post volumes dropped by 31% week over week. Still 21% higher year over year. A little bit of seasonality in the decrease. So next week we should see the third week of this trend that we're starting to see emerging. In the flatbed sector, very little movement. There was a slight downward shift to 35.33 loads per truck. Load post volumes in flatbed were up 6% last week, unlike the other two categories, but more trucks were posting for loads. So a little bit of life in that market. Shifting over to the dry van market condition index, when I look at our top 10 freight markets, they account for about 25% of our total volume. The top 10 market volume was down on average 18% week over week. The only bright spot was in Houston, where volumes were up 7% week over week. That was our number 2 market last week. But spot rates in all top 10 markets dropped this week, down on average 7 cents a mile. Even in Houston, where volumes are up, rates dropped 2 cents a mile to 2.85. Notable declines this week on the West Coast again. Los Angeles, Ontario dropped out of the top 10. The volumes there were down close to 25% week over week. Rates were also down 11 cents a mile as we come off the peak in Trans-Pacific imports. One of the number 1 markets in the country last week was Atlanta. Volumes there dropped 15% week over week. Rates were also down 10 cents a mile. So definitely capacity loosening and volumes dropping off in the spot market. On the refrigerated side, volumes also dropped in the top 10 markets, down about 22% last week. Only one market in the top 20, which accounts for 37% of our load volumes, increased last week, and that was the Southern Texas market of McAllen, our number 20 market this week. Refrigerated volumes definitely cooling off, capacity loosening. Rates were down on average in our top 10 markets, 11 cents a mile. But in Houston, spot rates were up 9 cents a mile. So capacity was a little bit tighter in the Houston market in particular, where we see a lot of refrigerated imports from South America. Over on the flatbed side, some late season life in the market. Volumes jumped 6% last week compared to the prior week. Some of the larger markets showed some volume changes. Memphis was number 1. Volumes increased 14% there. But spot rates were down 3 cents a mile in Memphis, so capacity loosened there also. Our number 1 market, typically Little Rock, rates dropped there 24 cents a mile, so capacity loosened quite quickly. And over in Savannah, rates dropped 20 cents a mile to 2.28. So looking at our year-over-year comparisons as we round out the year, capacity did loosen last week. Spot market rates decreased. They dropped about 5 cents a mile in the dry van sector to 2.25. That's a significant shift. They've been on the upward rise since early May, still up 41% year over year, and 65 cents a mile higher than the same week in 2019. In the refrigerated sector, spot rates dropped the most of the 3 equipment types. They were down 9 cents a mile to 2.39 last week, still 51 cents a mile higher compared to the same week, but definitely some temperature dropping there in that particular market. And lastly, in flatbed, rates decreased slightly again last week, dropping 1 cent a mile. They've been dropping 1 cent a mile for the last 2 weeks, but they're still in this tight band between 2.17 a mile and 2.20 a mile, excluding the fuel surcharge. They've been there for about 2 months. So rates there are up about 40 cents a mile compared to this time last year also. So that's it for the market update. If you want to find out more about what's happening in freight, go to DAT/resources and download the weekly market update. And that's it. Over to you, Ned.
So this week we're going to be looking at the long-term forecasts, and one of the important things about the long-term forecasts to talk to is that they have a lot of interesting information in them. So I think one of the important things is that we're going to give you 3 sets of predictions. We're going to give you one that's kind of shaded on the high side. We're going to give you one that's kind of shaded on the low side. And we're going to give you one that's kind of the consensus prediction, but it's not. Again, you gotta use your own judgment when you're looking out this far into the future. So
just a level set. This isn't the same as the short term, correct? This isn't the blended. We don't scenario model the long term. We just basically give a bull, a bear, and a base case.
Exactly. Yes. This is not multiple models melded together yet. We're working on something like that. But anyway, not important. Moving forward. So here we've got our dry van spot forecast. You can see in blue is the market rates observed by DAT. In gray is the year-over-year variance. So this is essentially if you took this point and you subtracted off what the prior year was, and then took that as a percentage, you get this. And then finally off to the right, we have our standard bull and bear case, standard in blue dotted, bear in green, or sorry, red dotted, and bull in green dotted. And you can see that even the bullish case is expecting a little bit of a market correction going in through maybe the start of Q2. And the bear is very bearish going in through looks like even July before there's some kind of seasonal leveling out and uptick. And honestly, I feel like there's definitely going to be some kind of a correction, whether it's as deep as like the bear case shows. We'll get to that, but
that's seasonality too, right, Ned? I mean, things will slow down. I think the most interesting thing to me looking at this is both the base and the high case show kind of a return to upward up and to the right, whereas the low case sort of drops with seasonality and then plateaus there. I think that's an extremely interesting look at it.
Moving forward to the reefer rates. Again, same story about what the graphs are showing, where blue is the market rates observed by DAT, gray is the year-over-year variance, and then we've got our base case, our in blue dotted, our bear case in red dotted, and our bull case in green dotted. And here, like with the prior forecast, you can see there's a little bit of an uptick actually for the next week, and I'm not sure that I buy that. I think that that's something that I need to look at correcting. There is probably going to be some kind of like a little bit of a seasonal effect, but honestly, I'm expecting just more slide going forward rather than just looking at the next week point on those. But yeah, no, like they're all showing a slide and then maybe a leveling off as we get into the later part of the year. And finally, we're going to be moving to the flatbed rates. Once again, same story about the graphs, where blue is the market rates observed by DAT, gray is the variance to the prior year, and then we have our base case in the dotted blue line, our bearish case in the red dotted line, and our bull case in the green dotted line. And you can see here we're also expecting a downward trend, and then it's a question of whether it stabilizes and heads back in our base case, or whether kind of the trend continues until we hit the later part of the year and then it slides. I think that's it for forecast. Is there anything else you want to talk about with forecast, Ken, before we move forward?
Well, I mean, I think this is these are nice to look at. They're lines on a graph. But if you're doing RFPs right now, especially as a broker that's going to cover on the spot market, I think this data would be critical to have as you're planning out your year, right? Because, what even the base case is showing is basically 2021 on average being lower, which I think is what we all kind of expect anecdotally. Mm-hmm. But if you go in and bid current market rates on your bids, I would suspect you're going to lose the vast majority of those, because folks that do have access to this rating data, this rating forecast data, will know that all signs are pointing to the market cooling off as we head into 21. Right. And be able to get a little more aggressive and win more business that they'll be able to cover profitably. Would you say that that's a fair use case for this data?
I'd say that is absolutely what this kind of data is designed to do. You need to understand taking just the exact what the line is saying, I think is not good practice, because your business is going to vary compared to like the basket of business that DAT looks at, in the same way that like, I know this isn't a very good analogy, but if you were to look at like the Dow Jones, like as a basket of stocks, your stock portfolio is not going to behave exactly the same as the Dow Jones. And you need to understand like where you're more exposed to risk and where you're less exposed to risk, and just that kind of a thing. And especially because you're targeting pricing exactly, understanding the relationship between DAT rates and your rates. But if you've been a RateView customer, I think that's something that you should understand, is that like on a given lane, am I running high, low, or at about what the RateView rate is?
Yeah, for sure. So with that, I think we're going to turn it over to the Ask IQ question for the week. But before we get there, I just want to put a call out. I know we're getting a bunch of questions. We'll get to those as soon as we're done with our Ask IQ question. But feel free, if you have any questions about this or anything going on in the freight market, to drop it in the chat or comment section below. We have a team standing by to feed those questions over to us, and we will try to answer those the best we can. So with that, I'm going to... Actually, Ned, I think you have the Ask IQ question for the week. I can't.
I do have the Ask IQ question for the week, and that is, I want everyone's hot takes for what is going to happen in 2021. Now, as hot takes, these are likely to be not the full picture of what's going on, but your boldest predictions, your Liv Moss for 2021, as it were, the fire sauce. Dean, you got something?
Slow start, strong finish. I think we'll see a continuation of the same into Q1. I think Q1 will be pretty slow, slower than most Q1s for some carriers. I see a continuation of a bifurcated freight market where volumes are going to be up in ports. Think about the 14 import and export ports. Volumes are up 22% year over year, driven by a lot of the channel shift and e-commerce retail sales. So that's translated into an 87% increase in load posts year over year in November. So imports rising. That'll continue through into the spring, because a lot of those spring volumes are being pulled forward now. So I think in very isolated areas, we'll see very strong volumes, especially in port markets where imports, exports are centered. I think we'll see a continuation of what we've been seeing in terms of overall economic activity. Home-based time and attendance has most states down about 20% in terms of number of locations open and number of people working compared to pre-pandemic levels. And they've been like that since July. So I think that's going to be more of a continuation of the same. And I think we'll see very tight driver capacity in the short haul final mile sector as more and more freight gets delivered in that shorter haul range.
I'll go next. I have 3 levels of spiciness in the mild take zone. I think that Ratecast is going to continue to get better. We have a lot of stuff in the prototype, beyond the prototype into the pilot phase, that is proving itself to be very effective in terms of reducing overall error and just making Ratecast more accurate. And it's been a product that we've been focused on delivering continuous improvement for. And despite the fact that it's been kind of a bear sometimes to work with and to get into a shape that I'm happy with from the back end side, I think that there's a lot of improvements that we can be delivering into next year. So, if you like Ratecast now, it's going to get better. So that's kind of mild because there's not a lot of spiciness there. In the medium heat take, I would say that I'm with Dean. I definitely expect a fair bit of reversion downwards. Like in general, freight cycles tend to be very cyclic, where there's not a lot of like long-term growth in the cycle. Ken has really pointed this out to me, and it's driven the point home, is that like if you look over the course of an entire freight cycle, it tends to end where it begins. And given that we're so high right now, just from like a overall perspective, I expect that there's going to be a correction at some point, and it's going to be pretty strong. And whether it's going to be over a long period of time or a short period of time is going to be kind of the question. Like a long period of time is easy to adjust. If there's like a cliff, then that'd be not great. For the spicy take, I plan to sit on the throne of an independent Principality of Portland by the end of 2021 and ride my knights into battle against Idaho to seize their bounty of potatoes. So there you go.
I don't know how I'm going to top that one. I think the hottest take I could provide is that I think 2021 will return at some point to what we would consider normal. And I know that seems so far away given where we sit in 2020. There's still, 16 days left. And I don't know that it'll happen in the first or second quarter. And what do I mean by normal? I mean, markets get overbought and then get oversold, right? Freight markets are in equilibrium for very short periods of time. it seems like. And that's why I really like those long-term charts. They pass through zero rather quickly, up and down. So, I think 21, we're seeing Class 8 truck orders. That's a sign of normalcy. We're seeing contract bids come back high. That's a sign of normalcy. All of those things will ebb the spot market back a bit. I'm fearful at the rapidity at which things could come back down. Right, you have a strong seasonal pull that's going to happen in the first quarter. You have potentially rapidly eroding fundamentals, and then you have anytime you ever have a regime change at the political level, there's always some uncertainty. So I think once we get through a quarter and a half of 2020 hangover in 2021, I think things will start to return to normal, and that normal will be most likely lower spot rates, higher instilled contract rates, and then looking ahead to the next rate cycle. So I think it's pretty weird when normalcy is your hot take. But so I'm going to turn it over for questions. I'm going to have to go back and I apologize. I'm still getting used to the back and forth here. So.
We saw one from Roadkin 1981 who asked, when will the California market come back up? And I feel like that kind of goes to the heart of what we were talking about is.
Before Dean gets into that one, I've been hearing this a lot, and I never would have thought of it, especially I should have thought of it coming from my prior company, but a lot of folks are basically saying that I've heard even in the last week, there's really no hope of getting it delivered. So everything has been brought further ahead, right? Because essentially, I'm doing some last minute Christmas shopping, and in years past, if I was 2 days before Christmas, Amazon Prime would get it to me. And now everyone's very pessimistic about getting stuff before the holiday. So my thought is that you're seeing that drop off faster, and we might actually see a little bit of a dip before it returns, as opposed to when we typically see a rally into Christmas. But what do you think, Dean?
Yeah, it's volumes have definitely fallen off pretty quickly in Los Angeles and Ontario. We typically head into, Q1's typically a quieter time on the international shipping front. But I think what will change this year is we'll see less pronounced seasonal effects on shipping, because a lot of us are buying things year round now. Online shopping is sort of more of the norm. So I think we'll flatten out a lot of that seasonality we typically see around major retail events. So I think what we'll see is the pull forward of the spring volumes is going to keep carriers pretty busy. What's watered down the impact on rates, though, even though volumes have dropped, capacity has loosened nationally. I think in the spot market, that's what's most interesting. So rates are coming off there pretty quickly on the West Coast, but they're still pretty high. So, they're still around $3 a mile, excluding the fuel surcharge. So rates are still pretty good off the West Coast, even though volumes are down. What we're seeing, though, this is interesting, with the congestion around Los Angeles and Long Beach, that freight is starting to be diverted. Shippers are moving that freight to further north to Seattle, and then around through Houston up onto the East Coast. So I think we'll see a shift in volumes off the West Coast to other ports that aren't as congested. And that's why we're seeing higher volumes around Jacksonville, Charleston, and Savannah, for example.
Yeah, I think this goes to Alejandro had a question. He was saying, I'm seeing LA, Ontario getting very loose, yet the ports are busy. And why is that? And I think that you just answered that, is that even though the ports are busy, people are looking ahead and seeing that a lot of that supply is getting diverted more northwards.
It's also the same as why a lot of people are ordering record numbers of trailers in the Class 8 space, because they're fearful. They want to lock in build slots, because manufacturers are finding it hard to get workers. Production has taken a hit because they've had to space workers out further. So I think that's one of the reasons that you're seeing congestion. Every manufacturer that we talk to certainly has had to slow down production levels as they space more workers out to meet the safety requirements. Port's no different.
Yeah, it could be honestly like a forward stocking of late January, early February demand as well, to get out ahead of Chinese New Year and things like that, right?
Yep.
I don't suspect that. Well, I can almost guarantee that port volume there right now isn't Christmas decorations.
Correct.
It's probably early 21 type of thing.
Jack from Uber Freight asks, any fundamentals driving the precipitous cliff in April year-over-year change, or is that simply cyclicality? I'd say that when you're looking at year-over-year change, one of the challenges about that is that there's 2 years that you're comparing, and as we move into 2021, the year-over-year, one of the things that's going to make the year-over-year changes start to look weird when you get into the start of COVID is that there were such rapid shifts in what the market looked like into there. Do you have any further on that, Ken?
So a couple things. First, I'd highly recommend, I think it's publicly available, or at least you can find it, I'm sure, if you request it, but the Uber Freight webinar that they did with the market kind of summary was excellent. So I highly recommend everyone check that out. Second, so there are folks in our industry, right, that stand to benefit from sensationalism, right? So the Black Swan folks that, the sky is falling, it's the best ever, the sky is falling again, right? So I want to be careful not to trade into that territory. But as the market has become more and more and more and more overbought, the model and as well as our fundamental analysis suggests that the probability of a very, very sharp correction has grown higher and higher. And that's, I hesitate to even say fear, but that's what I'm starting to, it went from a non-zero, very, very insignificant chance of that happening to a non-zero chance to now kind of a non-trivial chance of March, April being a very rapid correction down in spot prices. And why is that? You're going to have the seasonal fall off in demand. Once contract rates get reestablished at higher prices, whether that's, we're seeing right now 7 to 10% for asset-based carriers, 15 to 17 and even higher for non-asset, that's going to pull volume out of the spot market. And then you're going to have some of these truck orders hitting the road, adding more capacity. So you have more capacity and potentially far less demand for many different reasons. I think that could take the wind out of the sails of the spot market very, very fast. So I think that's what's driving that number from a technical perspective, as well as our fundamental analysis. You have anything to add, guys?
I think that things are going to get unsettled. I think that one thing that we haven't talked about and that the forecast can't model is the effects of the COVID vaccine. Like, to a certain extent, one of the reasons, at least in my mind, why prices are so high is because essentially like efficiency is down because those logistics networks are set up to be running in a certain way, and the shift to more home-based buying, the shift has kind of kept things unbalanced, and as they go back into balance, we're going to expect that rates are going to tend down, and so that's something that I think is worth talking to.
Well, here's what I think about, though. I don't want to talk in front of you, Dean, but I don't want to also lose this thought. If you think about ELDs should have put in all like if you study pricing mechanics or any of that kind of stuff, it should have put kind of an inflationary shelf in place, right? The cost to ship a 450-mile single driver shipment, 500-mile, that kind of friction point, should have become kind of systemically more expensive.
Right, because of effectively productivity, right? Yeah.
But it effectively didn't. So it's really hard to believe that what did you say, Dean? It's like 40 cents a mile higher year over year.
Mm-hmm.
It's hard to believe that in light of even less structural change, right? I mean, once COVID's over, things will go back to the way that it was from an efficiency standpoint. It's hard to believe that you're going to see even half that, even a 20-cent systemic shift in the inflationary direction. So for all those reasons, it's to the extent that since the reasons the market is rallying aren't systemic in nature, it would stand to reason that it will, when it equalizes back, it will come down just as far as it went up.
Mm-hmm.
And I'm not saying May, right, whenever rates were $1.10 a mile, but where is that equilibrium point that things settle back to is the question. And even $1.50, $1.65 a mile nationally before fuel for long haul is a long way down, from where we are in some markets.
Yeah.
And sorry, go ahead, Dean.
I'm sort of struck by the cyclicality of it. We had record numbers of Class 8 orders in late 2018, and that equipment came online mid-2019. We ended up with overcapacity. It feels like we're seeing the same pattern repeat itself all over again with a couple of differences. One is that, probably the most importantly, I think once we get through the darkest part of the pandemic in the next couple of months, what we'll see is this pent-up demand switching people hopefully back to more services. More services mean more travel, more fuel, more restaurants, more food. So I think there'll be a lot of pent-up demand that could change things mid-year. It'll be certainly well into Q2 before we start to see that pent-up demand start to materialise on the services side of the equation. So that's the bright spot that I'm kind of focusing on. But I agree. I think there will be excess capacity in the market in Q1 in particular that will have an impact on spot rates.
So I hate to tap the same person twice immediately in a row, but Alejandro, I think, had a question that tied right into this. Would you guys expect a record month for truck orders in December with companies trying to clear tax bills with such elevated rates in 2020? And that's not my neck of the woods. Dean?
That certainly plays a role. That happens every single year. That's why we always see that upward inflection in orders. This year's been a bit different. I think that it's because of people looking to book in build slots because of the impact of COVID on the supply chain, particularly in the manufacturing side. So again, it's a little bit out of my wheelhouse, but we always see seasonality towards the end of the year because of the implications of the tax code.
We're getting the shepherd's crook from our producer, but I think we can race through these last questions. So just rapid fire. Dane asks, why do you think the Atlanta market shot up so fast in truck prices and has now softened? What is driving that?
I'll have a crack at it. It's a largely inbound consumer market. There's always more inbound than outbound. So I think we saw that market cool off pretty quickly in the last little while due to a lot of inbound freight came in because people were looking to stock up. A lot of that inventory moved in October, and then it's shifted out around the southeast. So no great surprise there. Volumes have been coming off since early December in that particular market, and I think rates have cooled off this week also, down about 4.22%.
Finally, question from Stefan. Stephen Linton, I would not have expected reefer rates to drop as much as they have. What is driving this, and do we think it will continue to go down as the forecast suggested? I mean, I suspect that they're going to keep going down. I mean, I can be wrong, and there might be like a little bit of a blip at the very tail end of the year, but I feel like overall the direction is down. Do you guys have a take on that?
I mean, I do. I think it's got to do with how high they got. You know, there's been a shift in the refrigerated market. There's less truckload volumes of produce, but there's more volumes of frozen food and food for the supermarket channel. So we've seen higher volumes in that particular area. This year we saw a lot more volume for food-related items that people were using during Thanksgiving as they're eating more at home. So I think there's been more volume. That certainly drove up more volume in the spot market, but it's the fact that they reached $2.57 a mile the week before last week, and then they've come back down. So I look at it in the perspective of year-over-year comparisons. It's not that they've come down that much. It's the fact that they reached a fairly high point due to that high demand around the Thanksgiving point.
I think, too, a lot of states are back where they were in April. I mean, Pennsylvania, my neighbor state, my home state, shut down restaurants through the new year, right, for eat-in, dine-in. I know California is kind of doing a similar thing, and there are other states here and there. So obviously not as extreme of an effect as it had when the whole country was effectively doing it. I mean, we still have Florida with being Florida. But, with some highly populous states putting the clamps down on in-person dining, that definitely reduces the demand for commercial food service, which then in turn that's more on demand than grocery, I would say. So for fear of reprisal, I'm going to go ahead and wrap us up for this week and officially for the year. So first and foremost, I want to thank everyone. It's been really awesome to see this thing grow throughout the year. We're obviously in a new studio. We have a lot of really exciting things in store for 2021. And that's really just because you guys are interested in hearing what we have to say. So we hope to grow that. And again, if you have any kind of interest in us kind of coming on air in the next couple of weeks, probably not next week, probably the 29th.
I think it's not next week.
Yeah, not next week. I think the 29th if there's interest. And it'll be a much more informal, maybe just Q&A. If you get us some questions, we'll come on and babble about that for half an hour. I think that's something we'd be willing to do. Check out Dean's Market Update at the DAT website, and also check out Freightvine. Like I said, we're going to be rolling right into that next, and it should be out on Thursday afternoon. It should be chock full of really cool information. So with that, I hope everyone listening has a safe and happy holiday season. And if we don't catch you in a couple of weeks, we'll definitely catch you in January. Thank you.
Thanks, everyone.
Bye.